This is the Value Investor Podcast with Tracy Reinick. All things value, all the time.
Welcome back, value investors. It's not easy to be a value investor. In general, being one usually means you go a little bit against the grain because value stocks normally are, by their very nature, overlooked by Wall Street. Occasionally, there are value stocks that are all hot to trot, like we're seeing right now with the semiconductors and the airlines. But usually, value stocks are in areas that the mainstream market is rejecting. This can lead to a lot of self-doubt. You know how it is. It's that little trader voice when you think about buying a stock saying, why are you buying that stock? No one else is buying it. And if the stock stays down in the dumps a little while after you buy it, then the voice gets louder and you begin to doubt your research and your instincts. And you go on these chat boards and you look for reasons about why you should sell, or maybe why you should stay, but mostly why you should sell, so that those voices are still really loud for most value investors. And being one really means you're going against the herd, and that's really hard. Have you ever had a stock that's traded sideways for a year? What about 3 years? What about even 5 years? Could you hold on to that stock even if all the rest of the fundamentals were good after 5 years of it going nowhere? Especially think about in this market right now. All the FANGs are soaring. We're hitting new highs nearly every day. What if you were in a stock like Starbucks? Let's look at that one. That one hasn't done anything in, I think it's at least 2 to 3 years, or at least 2 years, kind of sitting there going up and down. Looks like it wants to break out now, but then doesn't. Could you hold on while everything else is soaring? That's the key thing for value investors, patience. It's a huge component of value investing, and it's really hard. So I took a look around to find some stocks that maybe have some of these conditions, that it hasn't been so easy to be a trader in them or an owner, an investor in them. And I wanted to look and see kind of what's going on now, because some of them might be interesting. So let's jump right into it. The first stock I want to talk about is Mexican cement giant CEMEX. That's CEMEX. The ticker is CX. Its shares have been trading sideways since 2009. Yes, 2009, everyone. It's been mostly trading between $5 and $10 a share. Occasionally it's dipped below $5. It did dip briefly or go above $10. I think it got close to $12, but that's about it for this entire time. So while the rest of the market has been soaring, you haven't. But if you've been buying at the lows and you got lucky and got it a little bit under the $5, and then you're selling at the highs, or, at $10, that hasn't been so bad for you. But long-term shareholders in CEMEX, it has not been good. So I was wondering, what could actually break the stock out of this channel? And could we see it regain earlier highs that it had in 2007? That's when it was trading at nearly $30 a share. So triple what it is now. So they pay no dividend. That's kind of a downer as well. For me as a value investor, I'm willing to be patient with some stocks if I'm getting paid for my patience. That's what I call it. So the company will give me that dividend while they're figuring things out, or the business cycle is down on its luck, but will eventually go back in their favor. But this one doesn't even pay a dividend. So that has been a problem for any long-term shareholders. But there's something going on in the emerging markets right now, and that's what CEMEX is. They're headquartered in Mexico. They actually do a lot of their business in all of North America and Europe and global. But between the U.S. and Mexico, that's almost 50% of their revenue. So a lot depends on what's going on in the U.S. with them too. So if the U.S. infrastructure and building picks up, then CEMEX could too. Now, I took a look at their fundamentals, which are really strong right now. So they have a PE of just 15.9, and their PEG is 0.85 because they're expected to have earnings growth of 37% this year. They also rank in the top 50% of industry ranks. So I like that, because their industry is starting to get some momentum. They have A-style scores across the board, both for value, growth, and momentum, because they're trading near those more recent highs at the top of this channel. So I like all of these. And as I said, the emerging markets, it looks like something is going on there, not just with these infrastructure plays, but emerging markets reflect what's happened with CEMEX stock over the last decade. It's basically gone nowhere, and it's underperformed the other major markets. And now it looks like, if you look at the chart, that it could be breaking out. I'm just saying it looks like it could, and we could start to see a new story with these emerging markets. Now, everybody has fled these. No one I know is in CEMEX unless they're actually trading it. Nobody's like investing in it, but it's one you might want to just snoop around in and keep on your list. Okay, another category that we've talked about a lot on the Value Investor podcast are the retailers. And I took a look at some of those. Now, consider, this is one I've not talked about actually, but consider Big Lots. Their ticker is BIG. I know what you're thinking, because I'm thinking the same thing. Big Lots, how can they even be competitive right now? But that's the problem. And that's why investors have kind of abandoned the stock. The 2-year stock return is just 13.2%. Over the last 5 years, the shares are up only, get this, 18%. So you're way better off being an S&P 500 index here than you were being in this stock. So basically it's being ignored. Nobody cares about Big Lots anymore. They have a $2.1 billion market cap. So they're not real small. And they have a lot of really good value fundamentals because, again, everybody's abandoned it. Their P is just 11.4. They have a PEG of 0.85. They're expected to grow earnings 15% this year. So they're doing something right. They are still getting that earnings growth. They have a rewards program called the Buzz Club Rewards. So I don't know if that's driving people there. A lot of rewards programs have a way of doing that, as we can see with Costco and with Ulta and some of these others, and even Prime with Amazon Prime. It makes you want to shop there more. So that could be helping. They do pay a dividend, so I did get 2.1% for my patience of holding on to this one. The industry rank is in the top 29%, which I know some of you might find surprising because they're retail, but they're on the discount side. So that has been doing much better than apparel retailers and some of those guys. So I do like it for that reason. They have an A for value in the style scores, A for growth, but they do have the D for momentum because that still just isn't there with the stock. But this is also one, if you're just really doing some bottom fishing on the retailers, but the rest of their Big Lots fundamentals actually look kind of decent here, then you might want to keep this one on your list too. And then our third company is in an area that has kind of been ignored too. It's in the financials, but it's not really, it's not like a small community bank or regional bank or anything. But the third stock is Raymond James Financial, ticker RJF. Yes, they've been around for forever, so we all know their name. They do wealth management. They have investment banking. They do regular banking services too. They're also big cap, $11 billion market cap. They're reporting earnings on July 26th, so they're coming up real soon. So you might want to check in and tune in to see the latest news on what's happening. But they've seen record client assets under management for 2 quarters in a row. And a lot of that has to do with rising stock market. Obviously, all those assets that are in the stock market are rising too. But their second quarter quarterly net revenues were record, up 19% year over year. And the first 2 quarters, it was a record start to any fiscal year. So again, the stock markets are at record highs. That has to help them quite a bit. They have great value fundamentals too. Their PE is 16.5. They have a PEG just under 1 at 0.97. They are expected to grow earnings this year at 30%. The style scores are a little mixed with them. They get a B for value. They actually get an F for growth. I'm not quite sure why with that PEG ratio and the earnings growth, but there it is. And they have an A for momentum because these shares have actually started to really rebound. They really didn't do much. They were in a narrow trading range from 2014 to January 2016. Remember when all the financials got really crushed down in January of 2016, including the banks, like the big banks all hit new lows then. So did Raymond James Financials. But then after the election, we started to see upturn in even these guys. Since 2017, shares are up 19.5%. But again, the value fundamentals are still good here. And it looks like they're starting to break out. So if you did have patience with this one, that's kind of been paying off for you here. And you do get the dividend with these guys too. It's just 1.1%, however. So you really had to have patience in the last prior couple of years. But I do like the financials still. This is kind of a hybrid financial one with the big wealth management and investment banking side, in addition to its banking services. So if you look at the charts for all three of these stocks, none of them look like Visa or Facebook or even McDonald's, which is like hitting new highs. Yet these value stocks do present an opportunity. Most investors are basically not paying any attention to these three. I know I wasn't. I had to look them up. Like, what do they do? Where are they? What do the charts look like? So you might want to just poke around in some of these as well. And remember, always do your research. Sometimes, certain stocks and even their businesses are just, they're just dead. They're not going anywhere, as CEMEX did. Now, CEMEX might have looked real juicy even like 3 or 4 years ago, and there would have been no reward there. So, all of these three are worth a look because stories change, business cycles improve, and things in the global economy change. And so it's worth taking another look at some of these, even if you've looked at them before. These are the kind of stocks that only us value investors can really appreciate, the ones that no one is paying attention. But that's what it's all about, being a value investor. And that is how you find some hidden gems. And that's how you get into some stocks well before the herd has been in them. We all know FANG. We all know those, and they've been great performers. And plenty of people making good money off of all of those high growth names. But value investing takes a little more skill, a little more investigation. So these are three to keep on your list. Again, it is CEMEX, which is CX, Big Lots, BIG, and Raymond James Financial, RJF. And as always, you can check out all of our podcasts on SoundCloud. You can actually subscribe over there. And you can also get it on iTunes on what is now called Apple Podcast. We have our own channel over there now for the Value Investor Podcast. So you can only get the Value Investor, or if you don't want that, you can get both Value Investor and Zach's Market Edge podcasts on iTunes as well. So definitely subscribe so you don't miss any of our episodes. And I'll be back again next week with some more value stocks.